just a restream being a little bit buggy. Just a restream being a little bit buggy. Okay, we're live. Finally.
Great. So, hey everyone, thanks for joining us. Today we'll be discussing DeFi lending, but we'll also have a free-flowing discussion that I think will cover a lot of different topics in DeFi. We have a great panel of guests with us today that I think will cover a lot of different angles from different perspectives in the DeFi ecosystem. So I think it'll make for a great conversation. We'll talk about a variety of topics. As I said, we'll talk about some of the big things that are happening and changing in DeFi in this dynamic ecosystem. We'll talk about some of the big challenges facing the space, as well as some of the really cool opportunities I think we have before us. So today I'm joined from, at least from my screen, from the left to the right, Eric from Injective, Stani from AAVE, Brad from Placeholder and Unisquare Ventures, and Andre from Yearn. Maybe we can go around and each introduce ourselves, a little bit about what we do, the places that we work, and so forth. So I can start. I'm Alex Evans. I'm a researcher at Placeholder. Placeholder is a venture capital firm. We invest in decentralized networks as well as protocols and projects that facilitate the development of those networks. We focus a lot on governance and economics. And so my research area is mostly on the economic side, focusing a lot on DeFi and what drives efficiency in DeFi are things that really interest me. So again, going from the left to the right on my side, we can then go, Eric, if you want to tell us a little about yourself, about what you're doing at Injective, then we can go Stani, Brad, and then Andre.
Yeah, hey guys, this is Eric from Injective Protocol. So Injective Protocol is kind of like a universal DeFi protocol for cross-chain derivatives trading, and it allows for access kind of like a plethora of financial products such as perpetual swaps, futures, and spot trading. And just in general, we have a fully decentralized stack with a vertically integrated DeFi protocol.
Yeah. Yes, I'm Stani. I'm the founder and CEO of AAVE. So practically AAVE is a on-chain interest rate market where you can deposit cryptographic assets and earn yield. And one of the biggest markets, reserves we have is stable coins. And when you deposit into the AAVE protocol, you can also use credit line and borrow funds, or then delegate that credit line to someone else to borrow on behalf of you. I think AAVE protocol was launched a bit over a year ago, and it has been very substantial in growth, mainly because it's quite developer-friendly protocol. Andre has been built a lot of things on top of AAVE. Before AAVE, I was building a project called ETHLend, short for Ethereum lending, since end of 2016. And it was probably the first, well, actually it was first lending, on-chain lending marketplace. And kind of like this small idea just led to another idea and grew into a community. Before that, I was doing law, and before law, I was practically building Web2 financial application, which is practically fintech. Yeah.
So hi, I'm Brad Burnham, and I've been in technology since 1979, investor since 1993, started Union Square Ventures in 2003, and focused on sort of the Web2 ecosystem and networks. And then in the latter part of in the late teens, we began at Union Square Ventures investing in crypto. A lot of that was led by an analyst of ours named Joel Monegro. Joel has since spun out to create Placeholder, which Alex described very well. And I am now a venture partner at both Placeholder and Union Square Ventures.
Sweet, and then I'll jump in last. I don't have actually as I never know how to answer this question, you know, because like it's what do you do on a day-to-day basis? And I guess the best description there is I'm some kind of coder, mad scientist trying to figure out what the hell works on ETH and what doesn't, and what breaks and what doesn't. And turns out 99% of stuff breaks, so definitely don't do what I do. I'm not actually, I'm a little bit of a code mercenary. I mean, I'm not actively associated with any one project. I mean, I try and build out a lot of stuff for AAVE, a lot of stuff for Yearn. I'm trying to help a bunch of other ecosystem projects. I always worry that, you know, it's very easy to get trapped in sort of tunnel vision mechanics in the DeFi space when everything is so interconnected and so leveraged on top of each other. So it's good to sort of have a little bit of a step back and a more of a bird's eye view of what's going on and where you want to play and where you want to do stuff. So yeah, I guess coder mad scientist is what I'll go with today.
I think my first question might build on that in a certain way, because obviously it's hard for any one of us on any given day to describe what we're doing. I mean, it's easy on a given day, but on a macro scale, you know, we're doing a lot of different things at any individual time because the space is so dynamic. There's so many interesting things to be done. I guess what I want to start off with is kind of the why, right? So we started out with a pretty insane year, obviously, in DeFi, a ton of growth, as Stani mentioned, in AAVE, as well as other platforms. In the lending space, in particular, as a bellwether for DeFi, has seen explosive growth. A lot of new things being created by people like Andre and others in the ecosystem, you know, constantly having new ideas and pulling them to market fairly quickly. So what I want to ask is what's unique about this ecosystem? What does on-chain lending and DeFi more broadly offer to the world? What interests you about it? What drives you to work on it? And so we can start actually in reverse order this time, Andre, and then we can go Brad, Stani, and Eric.
Well, I mean, to me, it's like how this has evolved, you know, from where it started. Let's say, I'd probably say it started about 3-4 years ago. You know, when you had the ICO boom, which back then I was a very vocal sort of anti-ICO persona because I really didn't like what people were doing. But the net effect is, you know, it created such a wealth of assets, and all of these assets today live on Ethereum. They don't live anywhere else. And thanks to them living there, we started seeing them, you know, breaching out into protocols that started popping up. You know, you started with Bancor, you had Uniswap, you had FLend back in the day as well. And like as they evolved, they started adding a lot of utility to these assets, and you could start doing more and more with these assets. But now, originally I come from a very boring fintech banking background, and it was so black box and it was so siloed, and you only worked on your own code base, and you know, you didn't share APIs between banks, you didn't share infrastructure, you couldn't leverage off of each other. So each one was building their own stack over and over and over again. And it was just so many wasted man hours. And now in this Ethereum petri dish, I want to call it, you know, there's all of these different little growing microorganisms and communities and infrastructures, and they're all open, they're all accessible. Because you know, when I first started building on top of other protocols, you don't ask permission. Like I don't need to set up a Zoom call, I don't need to set up a Telegram chat, I don't need to engage with anyone. I go look at their smart contracts and I start building stuff on top of them. Sometimes they don't like what I build on top of them, sometimes they like, but you know, that's also the beauty of this petri dish, is there's nothing that the protocols can do about what you do and interact with them. So the utility keeps exponentially increasing as we keep adding more and more builders, and they keep adding more and more components, and it just leverages on top of each other. But I do think a big reason for especially the growth we've seen the last year, I mean, it's a financial industry, right? Everything is fueled by growth, everything is fueled by greed, everything is fueled by expansion. So where the opportunity exists to be able to put yourself in a position to expand that greed, to expand that want, that's what's going to create the value proposition. And I think that's especially why the lending industry is the cornerstone at this point. I mean, originally I thought it was actually the AMMs and the trading systems, but I think lending is going to overshadow that, and to a large extent it already has, because lending allows the core want of greedy degenerates, and that is being able to take something I have, use it as collateral to get more of something else, and then use that something else to get even more of what I originally have, And I keep folding this position more and more and more. And that wraps the TVL and the AUM even more, because I'll provide AAVE because that's what I'm long on and that's what I want more of. Someone else is going to provide ETH because that's what they're long on, and they're going to borrow my AAVE to stack their ETH, and I'm going to borrow their ETH to stack my AAVE, and like the two of us are going to continuously trade off of that. And like it's this never-ending building on top of game, where the more participants you add, the exponentially more you grow these systems. Now, obviously, it helps a lot that we are in a very positive market, and we have been in a very positive market the last few months and almost going on years now, which is weird to say. But as long as those opportunities exist, this is going to keep expanding. So from the trader side, you've got this fantastic tool that allows them, to fold their position as much as the collateral factor or the TVL of these platforms allow. And on the builder side, you've got this completely open, permissionless world where everyone can just latch on top of each other and create more and more and more value. And then the thing I'm really excited about this year, especially, and this is something I'm very glad that companies like AAVE and Compound did, is because they when you design these protocols on Ethereum, it's very easy to not tokenize the output. So what I mean by that is, AAVE could have decided when you deposit DAI, you just have a DAI position and you borrow against the DAI position. But instead, they decided that you're going to have a DAI, which is AAVE DAI. Now, just because of that single design choice, I mean, it's a very small little design choice, but now I can use that ADAI in multiple other methods. And that ADAI is basically a redeemable token for the underlying DAI. So I can use it like normal DAI. Now, because of this tokenization, I can now build things on top of ADAI without needing to expose the DAI itself. So now, I mean, some will argue fractional reserve. I argue capital efficiency. It depends on which way you want to go. But we have this wonderful thing where we can use the same DAI in multiple systems and still do it in a secure, systematic way, so that if mass liquidations occur, it can liquidate all the way down to that bottom asset. And I think it's the combination of these things coming together that's just really going to make this even more explosive over the next year than it was over the last.
So I think the original question was, why are we excited about this space? And I can't imagine offering a better answer than the one Andre just offered. It's just the opportunity for developers to build on top of each other's work, and the opportunity for investors and financiers to build on top of each other's assets is a really, really interesting thing. And I've been sort of just using the shorthand of composability, that the thing that just blew me away when I first started watching DeFi was the way in which these things were composable, and how incredibly inexpensive it was to build on top of everybody else. And if you think about it over a much longer time horizon, that's been kind of the trend of technology since we first had any kind of distributed systems, lands, and things like that. But we've gone through a series of waves where there's a platform that lowers the cost of innovation, that ultimately gets captured by some other market mechanism and then begins to consolidate, and then a new platform emerges, again lowering the cost of innovation. And the really interesting question for me about DeFi is, are we sort of arriving in some sense at the end of history? I mean, have we decentralized to the maximum amount? Have we opened to the maximum amount? And are we, as a result, is there not another way beyond this? Is this kind of the last and fullest realization of decentralized systems? So, I'll just throw back, to the group for, after we've all answered this initial question, the description that Andre offered, and the use of the word leveraging on others' work and leveraging others' assets is so directly related to the flexibility and the efficiency and the composability of this ecosystem that it's, absolutely integral. Is it also a systemic risk? I mean, leverage in another context is often thought of as, leading to a systemic risk. So I think we ought to maybe come back to that at some point.
Yeah, I mean, I definitely agree in the points that Brad and Andre had. I mean, like, personally, kind of like what I like about DeFi quite a lot, that's very interesting, is the permissionless nature, in the sense that it's just not only kind of like to use permissionlessly different services and have the accessibility. I mean that by itself, it has a very big value proposition, because I think when we started a few years ago with Eatland, the kind of idea was to somehow create democratic interest rate markets that are accessible by anyone. And that was kind of like the theory and the vision that we had. And at some point, we lost the vision, in the sense that it was very hard to understand, or hard to get this vision in a wider adoption. And that was the time period where there wasn't ecosystem as of today that we have, because there's so many things that people are building, and you can practically consume different kinds of services. But now it becomes even more realistic, in the sense, Andre, for example, mentioned the A tokens in AAVE. So it's a simple design, in the sense that you deposit, let's say, DAI, and you get in return a DAI that increases in balance. But like what the idea there was, in some easy way to credit the interest rate to the user without going back to the protocol and claiming it, and also having like very direct number representation of actually like what you deposited and how much you earned. And what we didn't realize is actually that when you look at this A tokens, it's actually kind of like a permissionless savings account, in the sense that no one can come in between your yields and the protocol itself. And that's kind of like very powerful when we look at the lending space in general. I mean, we have to compare what's happening today in the mainstream. And one of the things is that the lending market's different quite a lot, but even on the earning side. So for example, I might have different kind of financial opportunities in UK or in Finland, or for example, if I would be in Brazil or Asia. And also, I might not have even access to USD denominated income the same way. And what DeFi does, it's actually just opens up everything in the sense, like creating, getting a bank account is super difficult. Generating a new address is fairly quickly. Like we do have a challenge still to onboard more users and onboard more, making the path from the legacy finance into DeFi. We do have obstacles there, but once you are in the ecosystem, it's just things are super easy, and you kind of don't want to go back. You know, when you go back and try traditional financial services, you kind of start to understand that like how far we have gone with the development. And this comes here comes to like the part I love the most is the permissionless way to build things. So when we launched the protocol, we kind of like we started to receive liquidity in various different places. For example, Andre, for example, had a protocol where you aggregate yield, which was pretty neat, Yearn, and that was the predecessor. And for example, a lot of liquidity came from there. It's just like you're just looking at, you know, the Etherscan and on-chain data, like where is this coming from? And you can't imagine that, you know, someone else, other part of the world is just building something cool, you know, and just like using your technology. And this wasn't the case when you were building Web2 financial applications. And that was like painful. Like, let's say you want to build an app that shows balances between two banks, bank accounts in two different banks. You have two different APIs, and they might have different terms and conditions, yada, yada, yada. And, you know, eventually it becomes too big of a nightmare to build. And then you have a lot of dependencies. And on the on-chain ecosystem, you basically have the same rules to build in some extent, because once you deploy, the contracts, anyone can consume them. They're accessible to everyone unless you put restrictions in, but that's a different case. So this kind of like permissionless way to build things is very cool. It's also somehow scary because it removes all of the kind of like economical modes and this old thinking that you build your clientele, you build liquidity, and there's still kind of like a thinking in DeFi that you can build liquidity and that's your competitive mode. But what I think what actually matters is the rate of innovation and kind of like how constantly you can just come up with things that actually improve your own users, and that is the kind of like a fascinating part, that we see constantly innovation, and you miss one day in DeFi and there's some new stuff already deployed, and some of the things that people are building, it's just like it's mind-blowing in the sense that how smart people there are, and just like it's also mind-blowing for me to somehow understand like how I can be like also like building in the same place with all of the same community, and in the same sense that there's so many like good talent here, so which pretty much is a kind of like a result, because the ecosystem is open, anyone can participate, and if you can build freely, whatever you build, there isn't like why would you leave unless there's actually like you can express yourself and what you're doing. So that's pretty cool. But on the Brad's thoughts on like whether things are decentralized enough, I personally believe that there's still like that it might take decades that we get the traditional finance to somehow plug into what we have here, and I just think that there isn't there's still so much things to build, and once we have like base infrastructure, which we probably have at some point, there will be still innovation. I don't think innovation ever stopped in traditional finance. It's just practically happened in the wrong side. Well, not in the wrong side, but in one side. So we saw a lot of innovation in the kind of like a front end of the banking, right? So financial technology applications were improving the user experience quite a lot. Where legacy banks had a lot of issues of keeping up with that with their own legacy systems, and what DeFi is kind of doing is innovating on the backends and making kind of like the backend of the bank more efficient. And I think there's still this efficiency arbitrage there will be still a lot of ways to go, and yeah, I would say the show is not over yet.
Yeah, I think the previous panelists really brought a very fair point about the general like kind of current landscape of lending and the greater DeFi ecosystem. And I would say that right now, like there's basically new innovation going on every day within DeFi. Like I think I'm still at the stage where I was like trying to understand, like all the rebasing and all the stablecoin infrastructure, and now there's that's almost 10 years ago now. And so I would say like right now, like basically we're just trying to like design and like build up this entire money Lego system. And eventually where we're trying to go is to build up this kind of like a Wall Street front end or back end, however you want to phrase it in this analogy, and really to kind of serve as like a global and like permissionless kind of like a financial system. Because one of the problems that I notice and we kind of take granted of in DeFi is that everyone can access kind of like the same financial system, like someone from Brazil, someone from Argentina, someone from Turkey, regardless of what their economic structure is, regardless of what currency they're using, they can all share within the same like DeFi lending infrastructure. They can still get the same rate as everyone else. And I think that's truly fascinating, especially given the current, macros with, the US kind of pushing the interest rate almost down to zero, and some of the other areas, with hyperinflation also shooting their interest rate way up. I think, if DeFi really grows at the rate it is currently now, it has the potential to really replace the greater financial infrastructure, and it'll kind of act as a balancing force between all the local, economic, isolated economic regions, and then kind of bring them more into the greater global economic system. And yeah, like I try not to regurgitate the same points that previous folks have already brought onto. And another interesting thing is that Injective works on derivatives, and Brad kind of mentioned leverage is a huge risk financial system, and it is something that we think about every day, and oftentimes every night. And I think that generally derivative is an argument for capital efficiency, but there's obviously a lot of kind of like a risk behind it, to say the least. And that's why, like most of these centralized derivatives exchanges have insurance funds. A decentralized one obviously does as well. And I think, like as we start seeing, all these DeFi systems start composing with each other, kind of building on top of each other, or, connecting very intricately with each other. One thing that we have to start worrying about is, kind of like a chain ship phenomenon, whereas in the sense that, if one of them starts burning, the rest of the ships will also start burning. And that's another thing that I can't sleep. Another part of the reason why I can't sleep at night is that, there's this kind of like old, like a Chinese story during the Three Warring Kingdoms, where it's like, there's this giant army, and basically, they had a very interesting innovation where essentially like all their ships are like kind of just oscillating kind of independently and causing a lot of seasickness amongst all the soldiers, and they decided to chain all the ships together, right? So that causes obviously efficiency, it causes them to move a lot quicker, and it causes all the soldiers to be a lot safer. And that is until someone attack one of the ships with fire, and the entire fleet is just gone. And I think, like that's a really interesting analogy for us to chew on, for the rest of the session, to think about, the more we're building on top of each other, the more important it is for security of base layer infrastructure. And yield farming, obviously, created a strong incentive for you to really battle test these. Like AAVE has moved tremendously quickly, and their TVL is a couple $2 billion. So if someone were to find like a security flaw within their system, they would have done it when they were at around 100 million. And I think the more we move up, the more we have to start thinking about the underlying security of it, like what if some of the base layer components starts decoupling. And I think that's something that, that's extremely interesting and fascinating to think about, and somewhat worrying to think about at the same time.
I think that's a really fantastic analogy, actually, Eric. I might steal it at one point, but I think it focuses us on, and each of you touched on this question of leverage on the one side as a powerful tool and risk on the other side, and how we balance those two. And one of the things that you bring up there with that, the analogy of the ships, is obviously redundancy is really important, right? And that if one component fails and then all of them fail, that's kind of problematic. And that's something that I've seen a lot of people in DeFi really try to avoid in some way, like as we're getting composable and using each other in interesting ways, having redundant components. So there's AAVE, but there's Compound, and there's other, parts of the lending ecosystem that are starting to flourish. Andre famously, helps all kinds of forks and competitive projects and all that in a collaborative manner. And so that's obviously one way, but, maybe we can make that a little bit broader and think about, how on the one side, we have, we talked about a little bit efficiency on the one side and fractional reserve on the other, as we're using things like A tokens, potentially tokenized derivative strategies on Injective, Yearn strategies, or whatever else. We have these trade-offs. And so what is the way that we think about, this fundamental trade-off of having resilient systems on the one side, but also, building so that we maintain the efficiency that we've been able to get and some of the pace of innovation that we've seen in the space?
Cool if I start?
Sure.
Yeah. So, I want to be a little bit of a doomsday sayer here, and you can't avoid the risk. Like it's there. You need to sort of accept it. Now, just like if you look at something like an internet stack, right? It depends on what layer the failure happens. Like on the highest level, let's say you've got your own Wi-Fi or internet connectivity or whatever, that goes down, it doesn't affect your neighbor. And you can play at that level. That's like your own wallet doing your own stuff. And then like one layer more deep, let's say it's a website you visit. If that website goes down, it affects all people interacting with that website, but not people that don't interact with the website. So that's like interacting with a protocol, let's say a Yearn or AAVE or whatever. One layer below that, you've got something like the ISP or the hosting provider. If that goes down, it's an entire segment that goes down. And like underneath that, you've got, your actual like CCOM cables and those kinds of things. And if those go down, a whole country goes down, stuff like this. So like I'm less worried on a protocol level because, if we're so interconnected, and like people have to understand that's the strength of DeFi, but that's also its biggest risk, and it's also its biggest weakness. Because if any of these protocols, and I'm talking about any protocol with a large enough, sort of foothold in the system, if anything happens with that, it has a cascading effect on everything. The boat analogy was beautiful. But like you can't really isolate it at a certain point. If something like Compound falls over, it's going to pull AAVE, it's going to pull Uniswap, it's going to pull DYDX, all of it down with it. And even worse than that, and the area where I'm a lot more terrified is on the asset level, the actual ERC20s. If something like a USDT or a DAI or a USDC or whatever it is, if one of those fails, it's pulling everything down with it. Like we often get this conversation with the Curve guys where someone is like, they don't like token ABC being in a pool because if that depegs, it's going to cause a risk for the LPs. And like my point there is, and Maker actually did a very good security analogy on this when they listed USDT, where their analysis showed like if USDT depegs, it's taking something like 60% of the ecosystem down with it. So they ended up using it as collateral, not because they wanted necessarily to accept the asset that is issued by a specific entity, but because the risk is of such a point that if anything happens with it, it's in any case going to break their system. So they might as well use it as one of their assets. And I think we're already at that point where the protocols are starting to understand that if something breaks, everything is going to break. So, but that comes with the very same tools that's making it so powerful. But at the same time, it's also causing protocols to be a lot more. I don't want to word. No, cautious isn't the word I'm looking for. Like supportive, also not the word I'm looking for. Somewhere a mix in between there, where if someone integrates with you, you're very pedantic about checking them out, making sure they're good, making sure their stuff is good. And I mean, Stani is a big proponent of this. Like he always gives me a lot of shit about my security practices because I think everyone at this point knows that that's not really my forefront focus, but it's incredibly important for him. So there's this constant, again, this leverage even in the security world where like the teams are aware of the cascading risk, and this means that it adds that extra level of caution, that extra level of precaution, that extra level of reviewing each other's work, helping each other with best practices, all of these things. And I mean, I can tell you from the inside out, the F security community is a very vibrant one. Everyone is in contact with each other, and like there's constantly new rooms being created to sort of help mitigate all of these things. But for people using these systems, they need to be 100% aware that there's a reason the reward is so high in this ecosystem, because it is a risk reward adjusted ecosystem. Like if you want safer bets, then you need to go into lower reward ecosystems, because our reward is as high as it is because the risk is as high as it is, and there's no mitigating it. There's no avoiding it. There's no sugarcoating it. It's there. It's not going to go away, and I personally think it's going to get exponentially worse.
Andre, can I ask a clarifying question? I'm probably the least educated, most naive in with the thought that there may be somebody in the audience that's also as naive as I am. When you say if something goes down, everything else is going to come down with it, there's the technical interconnection, and then there's the financial interconnection, and then there's just the sort of mimetic interconnection, and I don't really know what you're talking about. I don't know whether, is it not possible to isolate within the layers some technical risks so that you're not bringing the whole system down? And is it also not possible to isolate some financial risk so that if one protocol that interacts with the other protocols is hacked or broken or something, it doesn't bring the others down? I get it that if one of these major protocols fails, then there's going to be a concern that others fail. So the mimetic risk is going to, be there no matter what. But what exactly are you talking about?
Well, so I mean, on the Doomsday level, I'm talking about let's say, and this is purely for the sake of this conversation. I'm not one of the Tether USDT is going to collapse, prophecies. I don't know, sprouters, whatever you want to call them, but let's go with the Doomsday situation where it depegs, right, and like it's flooded into the market. So because it's interconnected in things like Uniswap and AMMs and MakerDAO, that means basically it's going to pull out all of the liquidity pairs in Uniswap. It's going to pull out all of the DAI in Maker. It's going to pull out all of the collateral in Compound, in AAVE. So like all of that is going to flood out of the system, and it's going to on less of a technological level. On a technological level, everything's actually going to keep working as it is, because on the Solidity or the Viper code, whatever you want to call it, it doesn't actually care if something like USDT is worth 1 or if it's worth 0.00001, but that's going to flush out, all other assets in the ecosystem, because all of these assets are so incredibly tightly coupled with each other. So if one of them goes down, it's a lot more of a financial risk, because it's going to pull all of those other assets with it, to the point where it floods the market with this thing. And like it's eventually going to reach a new equilibrium, but by that time there's going to be so much capital that is exited that it's going to hurt the system. But technologically, I'm less worried on a technological level, because technologically speaking, everything's going to keep working exactly as it's currently designed to work. Even let's say there's a new lender that pops up and it gets exploited by some dodgy collateral that gets added, and all of its assets gets withdrawn out of the system. It's going to have impact on those assets and that system, and it's going to be able to impact other ecosystems to the extent of the TVL that it had, but not much more than that. But it's still going to hurt them in terms of the available assets, in terms of the financial value of those assets, etc. But it's the beauty of being able to build all of these things on top of each other in such a way is also the curse of being able to build all of these things on top of each other in this specific way. And yeah, no, I mean, I'm not even touching the mimetic level, because we've seen the tiniest stuff in our ecosystem happen that gets exaggerated 1,000-fold when you start talking on the mimetic and the social levels, because I'm convinced we're dealing with fairly immature audiences on that side. That's always exponentially worse than the actual net effect. So speaking on those three levels, I think technologically it's going to work as intended. Financially, it's going to cause a lot of damage, and mimetically, it's just going to add an extra 10-fold on top of that financial damage as well. And that's the bigger risk. If you want to go down to a technological level, then the big risk sits in stuff like the EVM and the Ethereum compiler, and because like if all of a sudden there's a 0-day exploit in the SS store, which is the storage read opcode of the EVM, that's a different story. That brings down the entire Ethereum ecosystem. So and that's often an area that people sort of don't look at, because like everyone's so focused on what's happening in terms of like the Solidity code and the Viper code and these things that they often skip what's happening one level lower down that. Like there's I'm wondering how many of these ecosystem token holders are even aware of like the current EIP being proposed in terms of what the miners need to adopt, and the fact that ETH is potentially going to a burning system now. Like the miners are very against that, but the coders have already integrated it. If something goes wrong there, it pulls down ETH, and I mean ETH again has that same tripling effect it would have on all of the other ecosystems. So if you want to start talking technological doomsday, then that's down to the ETH core devs. So that's what 3 to 4 devs. If we look at GEF, probably the most used at this point. I mean that's basically 3 guys currently that we're putting all of this value on top of.
And it's basically going to a situation where more risk is added on even EVM level and also the actual network level, and like basically now we're going to the ETH 2.0 and staking. But also like if you start to pile up, the kind of like layer 2 solutions, side chains. You have these different kinds of like areas of risk. But I think it's not that like different. I mean, pretty much that's the problem of economics and how economies work, because they're so tied together. So practically if something blows up somewhere, there's going to be like, it's all collateral damage because everyone is exposed to everyone. The thing about DeFi is that you kind of are your mindset is always on the efficiency. So let's say if you have some sort of a collateral asset in a protocol, you also want to tokenize it and use it in somewhere else, and also tokenize it and have this layers and layers of capital efficiency. So your expose is more magnitude in that level. But one cool thing about DeFi is that you can actually quantify quite a lot of risk compared to if you look at something that's happened in 2008. Yeah, for example, like how you quantify how much other banks are exposed to each another. Because if you guys remember, like in 2018, what happened there is that like it was kind of like the aftermath that the toxic assets were found in different kinds of portfolios all the way in Europe and globally. And in DeFi, in theory, you could kind of like quantify it in a few seconds. There isn't that much tooling around, but there's enormous potential of because of the transparency to manage quite a lot of risk. But the thing is now, the way we're growing, there's just not enough tools and not enough people focusing on this part of DeFi, which is actually the most important part, because this DeFi is actually like it's going to be like the ocean. So you want to keep the ocean in good health, in my opinion.
Yeah, I think like all the aforementioned points like very, very fair. The most interesting point here is that like what we're facing within DeFi and just in general within Ethereum, like assuming that Ethereum is secure, or like even assuming that like all the L2 solutions that different DeFi projects are building on top of are secure. It's not that much different from like the traditional financial infrastructure where they assume that people are going to pay back their mortgages. Well, that didn't work out too well, but I think it's the good thing about like the ecosystem we're dealing with here right now is that basically people can quantify, parameterize it. Everything is fairly clear. Basically a few lines of query, maybe on the graph. Then you can figure out specifically what type of risk exposure are you like specifically facing right now. And obviously, one concern that we might have is that as we go building stack upon stacks, on top of this entire financial structure, that it might be a little bit more opaque by obfuscation. But I still think that if people do the work, it's still completely possible to decouple a lot of the confusions and just arrive at like a very clear risk parameter or risk level for you to evaluate. So I think that's like a huge advantage for DeFi, just in general. Is like exactly the risk exposure for let's say Tether decouples. Let's say USDC had some infinite minting issues, and I think that's honestly the beauty of DeFi itself, is that the system stays. It's just that a lot of the economic bodies and a lot of like the economics systems or financial systems that we're building on top of might collapse, or it might be severely damaged, but the system is still there, and people over time, it might take a few years, but it'll be built back up. Now, on the other hand, Brad mentioned the mimetic side, and I think a really interesting point that we haven't really talked about is that just how heavily correlated the entire crypto ecosystem is, and we're kind of just in this isolated kind of like economic or like financial body, in the sense that if Bitcoin goes to, let's say, $1,000 today, then a lot of the DeFi yields and a lot of the liquidity and a lot of the let's say like the value of total AUM, it just might go down with it over time, and that's just because Bitcoin is a more dominant market within this crypto ecosystem. So it is true that there are some things that's relatively more mimetic, but I think that what we're trying to build here is more like the infrastructure rather than trying to maintain like a financial system, because it just it's constantly evolving. I don't think that's going to change anytime soon.
So what I'm curious about is where that ultimately leaves us, right? So potentially we become less correlated with each other over time. Potentially we don't. It seems to me that a lot of these risks that we're discussing are a lot of also what's driving the activity and the interest on a lot of these platforms. There's a ton of risk. There's very, very high rewards if you are able to figure out right, but you could get rug pulled, something could get hacked. So the yields stay really, really comically high, and that drives a lot of interest and a lot of value to flow that way. That is, capital that's seeking very high risk opportunities. What happens, maybe some components ossify, maybe as Stani said, because we have a better understanding of how exposed we are to each other, or we know that Tether's a risk and we diversify from it. How does that, what is normalcy? What does an equilibrium look like in DeFi? I mean, I know Andre's chaos theory here already tells us that that's a contradiction in terms and we're never going to get that. But maybe somebody else has a different opinion. What does a stable DeFi look like? Do we go back to Andre working at a fintech company and us all being boring, or does it always stay crazy?
Well, I can say that, I mean, there's definitely some sort of equilibrium, because especially at AAVE, we do understand that there's a lot of risk involved in kind of not just the technical level, the technical as well, smart contracts and everything. I mean, it's very challenging to build the very, very diligent code. And I think Andre said previously here that kind of I think that Andre doesn't care about security, but the truth is that Andre cares quite a lot, and he does things very securely. Because I mean, building smart contracts and protocols is not an easy thing to do in general, and it's also kind of Andre has a lot of years of experience as well on development work. And I think, for example, we at AAVE, we try to be as risk aware, but also kind of try to balance with innovation. That's the most difficult part, to come into the market with new stuff, but still be very diligent. I think what's really cool that is happening is that and the opportunities are that you can actually build a lot of functionality and a lot of kind of protection into the contracts. So I think smart contracts in general, they solve a lot of things, not just the fact that it's not about giving funds to someone else and you don't have this custody, but it's also kind of it solved many of the issues we had in traditional finance. For example, if regulators want to understand what's going on, they pretty much see everything, all the transactions. They can build their own tools to quantify risk, and also developers, projects, they can build contracts where you might have more protection. We've seen quite a lot of protocols even coming recently where there's limitations on how much you can deposit, and all of this kind of restrictions. And I think it's a good way, because it also shows that you don't need to go completely kind of be too much like a Turing complete, in the sense when you're deploying contracts. And I think the more we are risk aware, but still we understand the audience, the ecosystem, and still realize that that we are not protected from all of the risk. That's why those yields are there, because there's not enough liquidity in the market, which is quite risky. And maybe our measures will decrease the risk and also might decrease the yields. And overall, as the space matures, it might decrease the risk. But I think kind of what we also need to understand is that people need to understand that there's risks. We can do our best, building protocols and be risk aware, ensuring that they don't go underwater, but still there's always a risk. But the cool part is that you can build risk tools, you can build protection, and you can build tools to quantify risk that helps on the front end as well, where you will deposit your funds, what's your risk profile, where do you want the funds to go? Do you want them to go higher yield or lower yield or insured pools, and and especially like if you tie, I think the insurance is a good example, because how economies are bundled together. So in DeFi, I mean, we have had a situation where there was actually insurance in one protocol, and the insurance protocol had some sort of issue. But in the same way, when we look at traditional finance, we have the exact same issues. Credit default swaps that were practically covering most of the 2008 toxic assets. They also they had to collapse on that sense. So it's very hard to build siloed systems, because economies are based on the fact that you grab yield by making business with each other. Protocols, smart contracts are making business with each other in some sense, and not doing that and siloing it will means that you're kind of like going against the opportunities. So it's a very theoretic but interesting issue.
Andre, I saw you unmuted.
Well, yeah. So as Stani was talking, it made me think, that there's basically there's these three components that are working together, and I think this is true sort of for any financial or economic market, where on the one side you have time, and the more time that passes, the more secure people feel with systems, and I think time is a very important factor. That's why you trust a system like AAVE or Compound more over something like Yearn. I mean, it's been around for a year versus been around for 2-3 years. Like that in itself is a big proponent for people. So time is an important factor in terms of risk versus reward. The one that sort of plays analog to that and a little bit complementary is available capital. As more capital flows into the system, and sort of and we see it in these lending protocols. When it starts with a little bit of capital, your interest rates are huge, because you have people that are borrowing out 100% of all of the available collateral at full capacity, and they're willing to pay high interest rates for it because they can't get it anywhere else. As more and more collateral flows into the system, interest rates keep going down, as you have less borrowers who are willing to put those assets to work. So that's a big reason why, in sort of traditional financial markets, interest rates are sort of as dismal as they are, because there's too much capital and not enough people that want to put the capital to use and actually work something with it. So I think that's sort of the second component. And then the third component, which again hooks into these two, is innovation. What new is happening, what new is coming out, what new is being built. And for purposes of this, and I don't like using this analogy, but I also love using this analogy, but it's basically, when do we run out of Ponzi's? Because if we look just at ETH, and let's say there was no assets originally and we just had Ethereum. Now the first Ponzi we created was basically, I don't know, let's say token ABC, because now where 100 people owned ETH, and let's say 50% of the ETH went into the ABC ICO. Now you have 50% holding ETH, 50% of the ETH is now held by that company ABC, and the people that gave their ETH for ABC are now holding ABC. So now you just technically increased ETH's monetary value, by 1.5x, because there's now 50% more sitting in the system. Now you add XYZ token, and then you add 123 token, and as you keep adding all of these new dilutions or new places for capital to be put, you're creating new sort of I don't know what the word, you're diluting the original asset over and over and over and over by adding all of these new ones. So as long as we keep this Ponzi wheel going, and we keep churning out new products and new tokens and new forks and new whatever else it is, that's going to keep being places where this capital can be deployed. And if that innovation plus that Ponzi cycle is happening faster than new capital comes in, you're going to keep having high rewards, because you're playing in a high risk environment. When that innovation stops and people start realizing, okay, but this is actually all scams and this is all pointless, then it falls back to the time-tested protocols that have been there, and sort of the capital starts evening out, which means there's less degenerate borrowers on the one side, more capital, rates come down, and then you sort of start getting to that let's call it safety area where, you know, people aren't willing to experiment or play with these new risky things, and they're happy with the ones that are there. So I think it's these three components: time, innovation, and sort of capital, that are constantly tugging at each other to try and see where they fit. But we're in a highly experimental R&D phase now, where, you know, I mean, we're seeing a new fork pop up every 12 hours with a new token that changes, I don't know, half a line of code, and then the whole internet goes crazy and excited about it for the next 24 hours until they move on to the next one, because within that 24 hours, 2 new ones popped up. And, you know, as long as we keep that wheel going, we're going to be in this high risk, high reward system.
Brad, I saw you unmute as well. We're up on time as well, but if you got a final comment.
Well, yeah, I mean, it's not so much a comment as a question. You know, something that Stani said earlier in the conversation is that, I think it was Stani who said that it's the most remarkable, one of the most remarkable things about DeFi is it's global, and it's exactly the same no matter where you are, what regulatory or jurisdiction you're in. That's a very cool thing, because, you know, we are at a point in the development of the species where we have to start dealing with problems like climate change at a global level. We can't do it, you know, at a nation state level. And so to the degree that DeFi is actually creating something that's forcing states to grapple with the inherent international global nature of the economy, I think that's really fantastic. But within that, you know, there's also this sort of notion of systemic risk at a global level. And what I'm curious about the possibility, there was this notion that the natural evolution of the ecosystem was creating some new protocols that are new smart contracts that had risk management built into the contract, which is a really cool notion, because it sounds like risk is being addressed on a decentralized basis, whereas in, you know, the traditional economy, it's addressed on a centralized basis by a regulator. And my question is it possible to imagine that we can solve the problem that Andre has, you know, scoped out for us, the sort of systemic risk, with a kind of natural evolution in a way that isolates risk into smaller and smaller components, and allows people to choose the risk level themselves without having to top down solve the problem?
I mean, I'm of the opinion, yes. I mean, if you look at something like, you know, Maker and their risk assessment and their caps that they put into their, how much DAI are you allowed to mint from any given asset, and they risk that up based on their team. Well, so yes, in terms of, you can codify it into a smart contract. AAVE as well, you know, with their LTV ratios, how much collateral are they willing to give you for a given asset, and then also the utilization ratio off of that. But like that is, as you say, top down still now, where, you know, it's a council that reviews and decides based on certain premises. We are definitely starting to move towards sort of more individualized versions, where, you know, like it's very easy for me to foresee a AAVE in the future where there's different tranches of sort of user customizable risk, in terms of, you know, I want a higher collateral percentage for my token ABC, but I'm only going to be providing collateral and borrowing against other people that are willing to accept that risk ratio based on my certain parameters. And, you know, like that's isolated in risk to the people who are willing to provide collateral there, but they understand they are getting more, but it's in a riskier environment, versus, you know, let's call it the A tranche, where, you know, that's your more secure assets, but, you know, it's more conservative rates and those kinds of things. So I think we're definitely moving towards it, and I think the pioneers there are like AAVE and Maker, especially in terms of what they're doing. There's not a strong focus on it currently, though, which I'll have to qualify. You know, like if I were to segment the developer DeFi community, you know, 90% of the guys are just sort of YOLO deploying new contracts and trying to see what sticks and what doesn't stick, with very little thought for, you know, what is the potential ramifications, versus Stani, I apologize for calling you old guard, but the old guard are more like focused on how do we make this more sustainable? How do we make this more scalable? How do we make this more secure? So I don't think there's enough focus on it currently. But in terms of is it viable, and will I even go as far as to say that will it be the sort of next iteration? Yeah, definitely. It's just not a strong proponent right now. We're in this sort of heavy innovation R&D phase that'll slowly over time begin migrating to much more how do we protect, and not what's the next cool thing we can figure out.
Yeah, and I have to add there also that practically kind of like the issue here is also a bit that the audience is quite immature in the sense that everyone wants those yields, but they don't kind of like want the risk associated or the losses associated. But somehow I feel that kind of like if you're not doing the job of a bit of like trying to think of a bit of a protection and a bit of like what could be the risks, and I do believe that people will deposit, allocate funds based on some sort of risk mechanism, because you want to, Sandra said that you want to charge a bit where like what kind of exposure you have. Like I want to deposit into, let's say, for example, into AAVE or Yearn in a way that I can decide, let's say I want to take, let's say, this risk, but then I get this exposure and being able to tweak it. So I think that is something coming also from the user experience perspective. But I think once we start to build this kind of like protection, it really shows to the traditional finance that actually we can do many things better. And if you can do risk better than they can, that's like big value proposition. And that is something that, let's say, regulators, experts from insurance field will appreciate, and that brings more liquidity and more interest in the space. And of course, I don't want to see, let's say, this kind of like a R&D building to stop. I mean, it's big part of the spirit of DeFi. It's practically what is important is that whoever is deploying, they practically have different kinds of security checks, and usually experienced developers are doing this thing. But also it's kind of like a platform for everyone to learn things and deploy. Of course, there's testnets for that. Sorry, Andrew, to say, but of course, like I think like Andrew's a good example where he had this kind of like a concept of testing in production, but so some people think about it as a way that that you don't need to use test nets, but it means that if Andre doesn't need to use, or let's say it's more of a kind of a way of Andre to build things, it doesn't mean that everyone else should do the same, in the sense that if you are coming into the space and trying to deploy something, and it becomes somehow gets traction and you don't have that much experience, maybe it's a good it would be a good option to actually deploy first on testnet. So I have nothing against Andre deploying in production, but I'm just trying to kind of like show that everyone can build in that sense, but it takes quite a lot of effort and skill to build contracts very well. And this is something that, for example, in AAVE, I don't think we like today we built way better than a year ago or 2 years ago. And I mean, that is why we did the version 2 of the protocol, because we got better. And that is why there's new protocols coming with new versions, because everyone is learning. Like we all were pretty much starting from ground zero in that sense.
Yeah, agreed for the test and prod part. I mean, it actually makes sense. Like, I understand why Andre has that philosophy, because basically it's essentially like a lot of times testnet, you don't necessarily find like the most critical things. If you just deploy a contract in prod, then you're essentially hanging around with a giant bounty, because there's going to be like early, risk takers, or like, I guess like quote unquote degens who are just putting their money in, and then slowly builds out a bounty. And then, if someone manages to attack it, that's kind of like like the most rewarding thing for like a black hat hacker to do. And this is also like the best way for you to find the most, let's say, obscure security issues in a sense. So I'm personally working on like Injective is working on something that's more on a layer 1 side, so we can't really do that because if something breaks, then the entire system goes down. It's like how for like Ethereum development, you really don't want a blockchain to go down. But yeah, like I would say like generally like in this almost in a sense is that like every single DeFi protocol is isolated on a technical nature. So basically it is parameterized in terms of risk, in terms of, it can be a variable parameter in terms of like the longevity of a protocol, how long it has been and how long it will be. And, like people can allocate their fund accordingly, putting a lot of money into something that's been around for a while, for example, like AAVE, for example, like Compound, and, allocate a slightly smaller amount of money into like some sort of like active trading strategies or some, let's say Yearn Vault and stuff like that. And maybe a little bit to like, play around with like stablecoin and debasing and, different type of yield farming strategies. And, I think generally, people are doing that accordingly, at least for, in a sense, like intelligent investors who are allocating their assets according to, I don't want to say it, but like Kelly's criterion. But I think like just in general, like that's kind of like the beauty of DeFi is that it is a money Lego, and you can take individual parts of the money Lego out of it, and you can stack on top of it in whatever strategy that you want. I would say the most, because right now we are working on this pretty interesting primitive, which is like yield farming derivatives, in the sense that, like we track the performance of a certain like, let's say strategy. For our case, we tried like the YFI USDT, and we kind of just track the performance of like 1,000 USDT deployed into a vault, and it goes down, it goes up linearly. We experimented in the testnet with a perpetual swap model, and that actually didn't work too well because we kind of realized that basically, it's a lot more sensible for us to do it from a risk level to do it in more of an expiry futures model. Because then this way, there's a final settlement versus like perpetual swap. There will never be settlement, and closing will cause like a cascading liquidity effect. And yeah, so I would say that, like for things you can test and prod, for a lot of things you should probably do some testnet.
So I believe that's all the time we likely have. I want to let everybody continue on with their days. This was a really, really fascinating conversation. I'm candidly looking forward to the recording so I can rewatch some of the excellent points you all made. So thank you so much for that. Thank you to Injective for organizing and I guess virtually hosting us. And I hope to see you all soon.
Thank you, everyone.
Thank you, everyone.